This derived forecast is from that of a sequential statistical analysis, which is referred as an algorithm, and with which I am in a position to give, based on the time frame, the day, which is divided into 3 sessions, how the market is expected to move. So swing and firm up during that of the Japanese session up to that of 7 GMT. Then 7 to 7:30 GMT is the gap time. They are expected to make a higher level swing, a false move on the higher side, and then make the higher level swing and slide during the course of the European session till close of European session as the week beginning false move. So the week beginning false move is part of the game, and what they do is they just pretend as if the market is weak and make the move. Then subsequently, which will give the impression to that of the traders that the market is going to be bearish, and then they take sell positions, etc. Then later on, the players make the move against the expectations of the traders. So this is what they do from time to time. So they are expected to do the week beginning false move either during the European or the US sessions. Then during that of the US session, they are expected to make the lower level swing and then rise. So always when you come across swing and firm up means they will do the lower level swing and rise, or firm up nominally, or a nominal rise will be seen. Then swing and slide means they will make the higher level up and down move and then slowly slide towards close of the European session. Then they will make the lower level swing, just make about 10 to 15 pip up and down move during that of the start of the US session, and then start slowly gaining the levels. So this is how the interpretations are. They are all nothing but the qualitative expressions of the market moves. So if you understand well, then it will be easy for you to take appropriate trading decision. Say for example, swing and slide, you can take a sell during the early part of the European session and book profit during the late part of the European session. Swing and rise move, you can buy during the early part of the Japanese session and then book profit during that of the rise expected to happen during late part of the Japanese session. But in the event if the market goes against our expectations or against the forecast, then we have the trading strategy to limit the risk. So you can either simply follow the forecast and trade accordingly, or fine-tune the forecast and also understand the long-term moves of the market. Namely, they are expected to make slowly swing and gain moves for the week. So in that process, what you can do, dips are buy opportunities. So whenever they dip and form the new low, you can take the buy, and then subsequently you can keep the hedge order to limit the risk. And once the market moves in your favor, you can keep stop at entry in the hedge and in the buy position. Then subsequently wait for the market to maximize the profit. And you can follow when they are going to quickly rise and book profit during that particular time. So this way you can make use of the forecast for the long-term trade also. So today they are expected to make the swing and firm up, and then swing and slide during that of the European session, and then swing and rise during that of the US session. Then tomorrow they are expected to gain during that of the Japanese and the European session, and make small swing and then firm up during that of the US session. After gaining some levels, they are expected to make the stop and down the downside. During that of the Wednesday, midweek, they are expected to make a downward dip and then rise and firm up during that of the European session, and then slide again during that of the US session. So this way, they will try to make the either way stop on the downside on Wednesday, and then rise and make the hit of the stops on the higher side. So that way a downward move and the upward move will alternate on Wednesday and Thursday, that will give the real surprise to the traders. So, and also you find nowadays they are making either way stop-ins in the absence of good volume from the traders. When the traders' volume is slowly coming down, then the players also find that there is no significant point in continuously rising or continuously dropping the market. So what they find invariably, when they just make the drop, then the traders liquidate the long and turn sellers. So the players are not in a position to drop further. If they drop further, what will happen? Those who have taken the sell position will book profit. So they just gain and induce the short sellers at the lower level to do the short covering. What the traders do, they just do the short covering during the rise and turn long in order to earn back the lost money. So when all traders turn long, what the players can do, they cannot rise further and give them the profit. So instead, they make the drop, so that those who have taken long position liquidate the long position. So here you find that the traders do the delayed trades, that is sell after that of the drop and buy after that of the rise as breakout trades. So in the event of such scenario of the traders, the players find that they have no other option than to do either way stop-ins. So whatever be the data release and whatever be the sentiment they create, and the data release, they are not able to make any consistent follow-up move, and they have to invariably stop the move, because once the predominant of the traders go in line with that of the market move, then obviously you find that the players have got a lot of limitations now in order to handle the market. In such a situation, they will prolong this sort of swings, and then they are expected to make aggressive gaining move during that of the last week of the month. So today it is the third week. Then the fourth week we could come across more aggressive gaining moves might happen in the market. So that when the traders think that, okay, the market is going to be range bound, whenever there is a rise, we'll sell, and whenever there is a drop, we'll buy. When they take a decision of that nature by looking into that of the chart, finding that, okay, this is the support level and the above is the resistance level. When it comes closer to the support, when they start buying, the players will make one more downward stop point. Then the traders think that, okay, the support is there at the lowermost level, and take sell position. Then they will gain the level, and afterwards the traders think that, okay, this is the resistance around 200-day moving average, so we'll take a sell. Then the players are expected to gain more and show the new higher level. This sort of shift in trading zone is expected to happen sooner or later in this month. So look for that and try to do only the buy and sell trade. Avoid doing sell and buy trade. If there is an opportunity to do the sell and buy trade like swing and slide, wait for the slide to happen and then take the buy position and book profit during the rise. So when you take the buy near the lowest level and keep the hedge order to limit the risk, maximum what the players can do, they can hedge you, and if you watch and close the hedge properly without any loss or with a small loss and continue to hold the lowest level buy, you should be able to definitely book profit on a daily basis. But after the rise, if you try to take the buy, there comes the biggest problem. So wait for them to settle and not reach the low set, and then you take a buy, you can do the position trade.